Welcome, everyone, and thank you for joining me today. We're going to explore a comprehensive guide to real estate financing. Throughout this presentation, we'll dive into the different types of transactions and financing methods, examine the legal framework that governs these deals, identify the key participants involved, discuss potential risks, and look at practical applications to help you navigate the real estate financing landscape with confidence. Let's get started. When we talk about the scope of real estate financing, we're really looking at a broad range of transaction types. This includes everything from residential mortgages for home buyers to commercial loans for businesses, as well as construction financing that supports building projects. Beyond these, there are other important forms of financing like bridge loans, which provide short-term funding, equity financing where investors contribute capital for ownership stakes, and traditional debt financing involving borrowed money that must be repaid. A couple of key concepts are essential to fully grasp these transactions. One is leverage, which is essentially using borrowed capital to amplify the potential return on an investment. It's a powerful tool, but can also increase risk. Another critical measure is the loan-to-value ratio, or LTV, which compares the loan amount to property's value, helping lenders assess risk and determine how much to lend. We also need to consider interest rates, since they directly impact the cost of borrowing and ultimately affect affordability and profit margins. Finally, the loan terms set the framework for repayment, outlining the timeline and specific conditions borrowers must follow. All these elements together define the financial landscape in real estate transactions. When it comes to financing property purchases, there are a few key methods to consider. First, mortgage loans, which are the most common. These loans come from banks and typically involve either fixed or variable payments spread out over a period of time. Next, we have seller financing, where instead of borrowing from a bank, the buyer makes payments directly to the property seller. This can sometimes offer more flexible terms. Finally, government-backed loans like FHA, VA, and USDA loans are designed to make homeownership more accessible by providing favorable terms or specific eligibility benefits. Each of these options serves different needs, so it's important to understand how they work to choose the best fit. When we talk about the legal and regulatory framework in property transactions, several key elements come into play. First, disclosure requirements are essential because they ensure transparency about all loan terms and fees, so borrowers know exactly what they're agreeing to. Next, recording liens is a crucial step. It establishes a legal claim on property, protecting lenders' interests. Usury laws also play a significant role by limiting the interest rates that can be charged, preventing unfair lending practices. Consumer protection acts are in place to safeguard the rights of borrowers, making sure they are treated fairly throughout the process. Title insurance is another important factor here. It provides protection against any ownership disputes that may arise after the purchase. Lastly, escrow arrangements help manage funds securely during transactions, offering peace of mind to both buyers and sellers. Together, these components create a structured and fair environment for all parties involved. When it comes to financing, several key parties play important roles. First, we have the buyers. They are the ones seeking loans to purchase property, so their financial situation and needs drive the process. Then, we have the lenders, who provide the actual funds and carefully assess the buyer's creditworthiness to determine if the loan is a good risk. Beyond buyers and lenders, there are support professionals who help make the financing process smoother. Brokers act as intermediaries, connecting buyers with lenders who match their needs. Attorneys are involved to review contracts and ensure everything complies with legal requirements. Title companies verify that the property's ownership is clear and provide title insurance to protect against any claims. Appraisers assess the property's value, which is crucial for accurate loan underwriting. Finally, underwriters analyze all the information and decide whether the loan should be approved based on a level of risk. Each of these roles is essential in helping buyers secure financing safely and effectively. When it comes to real estate financing, there are several key risks we need to be aware of. First, borrower default is a major concern since it directly affects loan repayment. Then, fluctuations in interest rates can impact the borrower's ability to afford their payments. A decline in property value is also risky, as it reduces the worth of the collateral securing the loan. Title defects can lead to ownership disputes, which complicates the financing process. Lastly, regulatory changes can alter the conditions under which financing is provided, introducing additional uncertainty. To mitigate these risks, a number of strategies are essential. Conducting thorough credit checks helps assess the borrower's ability to repay. Securing title insurance protects against any ownership disputes that might arise. Using fixed rate loans is a smart way to stabilize payments despite interest rate changes. Employing escrow accounts ensures funds are managed securely and dispersed properly. And finally, strict adherence to legal and regulatory compliance is crucial to avoid violations and keep the financing process smooth and secure. These strategies together help manage risk and protect both lenders and borrowers. Let's look at some practical examples to better understand different types of loans. First, the residential mortgage, which is typically a 30-year fixed-rate loan. This type provides predictable monthly payments and long-term stability, making a popular choice for home buyers. Next, we have commercial loans, which often feature balloon payments. This means that after a series of smaller payments, there's a large final payment due, which requires careful planning. Then there's a construction loan, which starts as short-term financing to fund the building process, and once the project is complete, it converts into a permanent mortgage. Lastly, seller financing is an alternative approach where the buyer makes installment payments directly to the seller, bypassing traditional banks. Each of these examples highlights different structures and purposes based on the borrower's needs. To wrap up, let's review the key takeaways from our discussion. First, it's important to recognize the different types of real estate financing, whether that's residential, commercial, or specialty loans, each serving unique needs. Next, understanding the various financing methods is crucial, from traditional mortgages and construction loans to seller financing and government-backed options. We also cover the legal and regulatory requirements that help protect all parties involved in these transactions. Equally important is knowing the roles of the different participants in the financing process, as each plays a vital part in ensuring everything runs smoothly. Finally, identifying potential risks and applying effective strategies to mitigate them is essential for safeguarding your investments over the long term. Keeping these points in mind will help navigate real estate financing with greater confidence and clarity.